Trump's tariffs continue to weigh on crypto markets, but dips keep getting bought quickly. Volatility resets lower as BTC consolidates, which could indicate downside exhaustion, and ETH shows signs of recovery from oversold conditions and with an upgrade due in March that some think could provide optimism. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave from FRNT. It's just us two in the studio today.
I know.
How's it going?
Yeah, good. Yeah. Good to be back. Good to be back.
Good to be back.
It was great last week. Really enjoyed last week.
Yeah, it was lovely. It was a nice studio and a great panel discussion, right?
Yeah. No, it was good.
So what are we thinking this week?
What are we thinking? I don't think much, like in terms of anything changing. Tariff headlines still dominating everything.
And they're going to for a while, I guess, right?
Yeah, but I think the interesting thing is they're kind of losing their impact. So if you think a week ago when he announced the tariffs on Canada and Mexico, markets open Monday, dumped, and then obviously that got kind of rode back a little bit. And then going into this weekend, we had the 25% tariffs on aluminium, and
that barely had any impact, right?
Yeah, and the kind of initially like crypto sort of dumped, a mini dump, and it was quickly bought into.
Yeah.
And then equities, by the time markets opened on Monday, equities have kind of digested it and haven't really moved. But I feel like it's causing markets to build in some sort of risk premium just on that headline risk, I guess. But then offsetting that, I still think the macro is looking like super supportive for a continued leg higher in everything.
Bond markets had a bit of a rally.
Bond markets had a rally, and again, like I've been talking about fading, like the dollar and yield moves that we kind of really pumped into Trump coming in. They have topped out and are coming lower. What was really interesting was comments from the new Treasury Secretary, Scott Bessent, in an interview last week, and I actually think it's probably not got the attention that it should get. And he was laying out his kind of economic policy, this 3-3-3 policy, where he wants 3% deficits, which is down from the current circa 7%. He wants 3 million more barrels per day of oil being pumped out, and he wants 3% sustainable non-inflationary growth. And he spoke about sort of wanting lower rates. And again, I think he's a bit, a wily character, right? Being a markets guy, not wanting to put pressure on the Fed, kind of alludes that we're not talking about Fed rates. We want 10-year yields lower. And that's actually what I tend to focus on in a way, as I think so much that's the benchmark, right, for yields across sort of markets. And
it is interesting though, isn't it? It's like everyone was thinking that tariffs and all that were going to be so inflationary and the long end of the curve was going to collapse and yields are going to go through 5, and it's like the opposite, right? Yeah,
and I think again, like everyone was sort of positioned wrong way for that. And yeah, like
is that because Doge? Do people believe that Doge is actually going to be able to make a difference?
I mean, look, they're talking about like reducing the deficit. I don't think they will, because I think Doge is literally not going to touch the sides, and because they're too big.
But they're talking about like reducing spending by like 2 trillion or something. Right?
Yeah, but like kind of good luck with that, right?
Yeah.
Fine. Like they're doing the right thing by all this. I mean, God, you can imagine if they did it here in the UK, right? The amount of money that's just kind of going in people's back pockets and whatnot. So they're doing the right thing to like chase down wasted spending, and it will be in the hundreds of billions, I'm sure.
Yeah.
But the two biggest line items on the US spending are interest payments and social security spending being number one. And you can't. It's really difficult to cut back on the social security spending, and obviously the market determines essentially where the interest costs are going to be, which is why I think that's probably one element that they can try and impact, and perhaps why they're so keen to try and get 10-year yields down. So I think it's interesting. I also think as well actually our friend Raoul Powell talks about, using like the dollar as like the kind of stick for negotiations, because no one wants a stronger dollar right now. And then the carrot being a weaker dollar and lower yields. I think like that's going to be the plan. So they kind of threaten tariffs, and then once they'll get around the table, what they offer up is like, look, you cooperate with us. We'll all work together to get the dollar weaker. We'll get lower yields so that we can have global yields coming lower. And then we can stimulate global growth, which is going to benefit everyone. So I kind of think that's the long-term game. I
think that's what the market thinks as well, because they don't seem phased by tariffs, really.
No, and I think it's kind of coming around to that. And we spoke about last week saying that, you know, just like it's not random chaos with Trump. There is actually method in the madness. And I think maybe the market is starting to understand that. And ultimately, what do Trump and Besant like explicitly want? And they've said this, right? They want a weaker dollar, they want lower yields, they want lower oil, they want higher stocks, higher Bitcoin, right? So that's how I think everyone should be positioning and thinking about. Now they're making good headway on oil. I think oil was like 10% lower since the inauguration.
I'm a little surprised on China that they don't seem to be talking that tough against China.
No, and that in itself is really interesting, right? I said it was the dog that didn't bark in the night. Yeah, like, and obviously Trump had the call with Xi a couple of weeks ago. It was a great call, very Trumpian language.
It was the best call ever.
It's the greatest call. It's a perfect call. But yeah, like it was quite interesting. And then like the 10% tariffs, like it feels like there's some backdoor negotiations going on, and Trump still has to be seen to be being hard on them.
And Chinese stock market's slowly going higher and higher and higher.
But China will be so important to 10-year yields coming lower. And if you look over the last couple of years, like when 10-year yields, was it back in 23, November 23, and Yellen went out to China, and then next thing we had this dovish pivot from Powell. The 10-year yield started coming lower, and then actually if you look at the tick data, China started buying treasuries again. So it's going to be interesting over the coming weeks and months. I wouldn't be surprised you'll see like China have picked up their pace of treasury buying, and they're going to help yields come lower. I think it's really significant that Trump isn't bashing China right now, because that is actually the one that, you know, he has real issues with.
Yeah, and he's gonna he would have public backing to do that as well.
Yeah,
right. So, okay, what about gold? Because gold is flying, right? So generally, when we see gold doing that, we'd expect Bitcoin to be doing at least that, and it kind of isn't. There's a bit of a decoupling between Bitcoin and gold right now. What's that about?
Yeah, well, I think there's a few things, and again, not the expert on this, but like there's a lot of talk about there not being the actual available gold at exchanges for delivery.
And these tariffs are also impacting the price that people can get their hands on the metals potentially, right? When these tariffs go into effect.
Yeah. And look, gold still does play like the ultimate safe haven role in all this stuff. I also think it's still like, if you look in China and central banks, you know, before Bitcoin, until Bitcoin becomes a reserve currency or a reserve asset for everyone, gold is like the kind of go-to asset that they'll want to sort of buy.
And gold is tradable on Deribit now.
And gold is tradable on Deribit,
tax gold, right?
Yeah, but I do think it's interesting. I mean, you think about if there's a supply shock and supply issues around gold, and that's sort of driving it up. Well, like, you know, Bitcoin, you think about one of the big factors of why we're all so bullish on Bitcoin. And yeah, I do think you know, there's it's kind of picking up on the underlying macro and this easy liquidity environment. And if we do end up having, which I think there's a pretty high chance that we have some kind of Shanghai Accord where they agree to get the dollar lower. Maybe I feel like gold's sort of sniffing that out, perhaps ahead of Bitcoin at the moment. But I think we'll see that recoupling. And that's why I can't look at gold flying higher and not be bullish on Bitcoin. So when I keep having people say, oh, maybe this bull run's like over, my view is it's not. And we start to see yields and dollar come lower, which I think there's signs are happening. It definitely feels like we've topped out. That is going to be a massive tailwind for Bitcoin. So I kind of feel the macro's lining up. We still haven't started drawing down as well yet on the TGA and all this stuff. So there's a lot of liquidity to come in.
Right.
We start getting a lower dollar, lower yields. and we're going to fly. And I kind of feel this headline risk around tariffs is just, I mean, we've not really gone anywhere, right, for the last like few weeks, or really since the inauguration. But we kind of, in my head, like we're trading like a 95, 105 type range in Bitcoin. But I do feel like we're building up to sort of pump to the upside. And the thing for me as well is like, we sat, just below 100K, and the sentiment out there is awful. So I really feel, and I'm having people sort of hit me up and say, do you think, I'm hearing people talk about 70K and targets like that. I'm like, I just don't see the conditions for us to wash out like that. And we had the biggest liquidation event in crypto history the other week.
Yeah.
And here we are back around 96, 97K. I'm like, I think, you know, it's a sign of there's this real institutional demand that is still coming into this market. And I still think, and I know I'm always bullish or at the moment, but I still think the macro cycle is supportive of a break higher. I think the flow dynamic and the demand dynamic is supportive for another move higher. So I kind of, timing these things is really difficult, but I do feel a break to the upside is imminent.
Interesting you say that, because looking at the options flows, we did see vols get smashed over the last week, right? Yeah. So we had the big drop, vols obviously spiked. Then as the market consolidated near the lows of the range, vol got crushed, right? People dumping calls, doing all kinds of stuff. But literally in the last day or two, because the vol is battered, people are now coming in and buying calls in March in that 110, 115K kind of area.
Interesting.
So it's sniffing out some value on the upside, basically. Yeah. So that tide is slightly turning. ETH obviously had the bigger move down.
Yeah.
There have been bullish flows in ETH as well. And like the skew, that sort of caution that you're saying, people talking about 70K and stuff, the skew is reflecting that risk, right? So you've had skew curves steepening in a way where you've got puts bid in the front and calls still bid in the back. But even that call bid in the back that's been so persistent has started to dribble lower. So you've got like Bitcoin calls, maybe a couple of vols, call premium in the back end, and maybe sort of one vol put premium in the front. Whereas ETH's curve is much steeper. So you've got maybe 2 or 3 vols of put premium in the front, and 3 to 4, maybe even 5 vols actually of call premium in the back. So that's kind of like the options market saying that ETH's a madman on the downside and could go a lot lower because it just is high beta, right? But we still think ETH is value on the long-term basis and could re-rate higher massively at some point. So that's kind of what the skew curve's telling you there. I'm also in the same camp where I think that ETH's got so battered, we've had that big liquidation, and now it's actually digesting it quite well. It's starting to show a little bit of strength relative to Bitcoin. If you look at the ETH Bitcoin cross, and you've got this upgrade, Pectra, or I can't remember what it's called. You've got an upgrade coming in March, basically, right? And you know, we've seen that historically, some kind of bid, often it catches a bid on these upgrades, right? This is for scalability, this one, whatever. So there might be a little moment in the sun for ETH to get its head back above 3,000. Does that mean it's going to outperform Bitcoin in the next 6 months? Probably not. But given how battered it is, the vol is holding. It's about 20 vols over Bitcoin still. So the gamma's performing, the vol's holding, and people do still see some value in owning that stuff.
It's funny as well because I'm not a Bitcoin maxi by any stretch, but most of my focus, and certainly being a macro guy, is on Bitcoin, and it's what I hold most in my own portfolio and whatnot. So I kind of feel really relaxed about the market because we're off like 15%, from the all-time highs. But obviously, like altcoins have been absolutely smashed and really beaten up. But actually, again, it's like if you step back and you think of all previous bull cycles, it's actually only Bitcoin that's probably not had the level of sort of like sell-off that you'd expect, on a bull market. But maybe again, this speaks to that this new demand and this demand shock that's from all this kind of institutional money that was sidelined and now it can all come in. So maybe that 15-20% is the new kind of correction for Bitcoin. Alts have had a more typical correction at this point. But if you overlay this cycle with past cycles, it's all very in keeping with what you'd expect. So and with or without all this tariff headline news. So I think everyone gets bearish at the lows, but it does feel like we're chasing out a pretty normal cycle, and we've got all these massively positive catalysts, you know, from the administration and whatnot, and still the macro kind of looking favourable. So there's nothing that I look at to think we're not gonna have this final kind of really steep, like explosive move over the next few weeks, months, what have you. So
yeah, and I have
don't
to
lose the
concur.
faith.
I have to concur that the price action, when we see dips in Bitcoin, the way it gets bought so quickly, I mean, it is very constructive. Anyway, on to this week's guests. So I got to sit down with a couple of prop traders in the crypto vol space, one from Alphaberry Capital and one of the guys from GSR on the market making. Well, he doesn't market make, but he works for GSR. Have a look at what they had to say. It was quite an interesting discussion. Okay, guys, today I've got my special guest, Evgeny Filichkin, Managing Director at Alphaberry Capital, and Singh, Portfolio Manager at GSR. How you doing, guys?
Wonderful. Thank
you. Yeah, good. Yeah, definitely. Good to meet you. And I'm really looking forward to this discussion because it is going to be all about crypto options, which obviously I love. So before we get stuck in to the meat of the discussion, why don't you guys tell us a little bit about your backgrounds, kind of how long you've been trading, and you know what you did before crypto, and kind of what your roles are now at your various shops. Evgeny, you want to go first?
No problem. Thank you for this invitation. Actually, I came from the brokerage business. Initially, I was involved more than 10 years, around 12 years in brokerage business. And actually, I believe that's a great school because you manage not your position, but the position of your clients. And sometimes you have nothing to do with that. So you're always thinking about hedging your exposure, liquidity providers, and how you're going to connect all this between A and B book all together. So after that, when you try to trade yourself, it's much more easier for you, I believe, because you are the one who creates situation, but not on the other side when you just get the situation and you need to deal with it.
That's right.
So, right now, I'm running the Alphaberry Capital. That's a prop trading company. So basically, we love to explore and to exploit market inefficiencies. And yes, we are into derivatives, mostly into options. Also, we love playing with funding rates and those stuff around this. And actually, I think that's okay. I think we are leaning towards market neutral approaches mostly, but it doesn't mean that we do not allow ourselves some risk exposure. But of course, we just assess, and based on certain parameters, we can be more exposed or less exposed, or we can be totally hedged and just keep market neutral for months, unless we just go again in the market and allow ourselves, let's say, to have some directional position or other thing. So that's, I think, what I wanted to say. If you have any question, please feel free.
Of course. And how about you, Simran?
Thank you. Simran Singh at GSR. My background is in traditional commodities. I was a commodities trader at Goldman for a few years. Had a blast. Used to think it was the wild west of asset classes. When oil went negative is when I like to say I got my first 2 white hairs in my beard. And that was certainly a trial by fire kind of period. And especially when things that are never supposed to go negative, it has some interesting dynamics on the vol surface.
Break a few models, right? Yeah,
exactly. All models are on. Some models are useful. You find out how useful your models are when things like that happen. I dabbled in crypto back in 2017. Was interested in the space, and then nothing kind of really DeFi summer when I started getting deeper into the weeds. And in 2022, I made the decision to join crypto full time as a profession instead of just an informed hobbyist. So I've been at GSR ever since then. Currently, I run our Alpha Strategies group as a portfolio manager. Really means is we're running a bunch of semi-systematic, medium frequency discretionary trading strategies. So that is, long, short relative value, delta neutral funding trades, as Evgeny mentioned. Also, given my background in vol, I love looking at options, whether it's looking at term structure, looking at 1x2 to trade skew, just trading implied versus realized. The market has certainly grown in terms of its opportunity set, but I would say it's far from where I envision it will be in the next 5 years as you have more and more players entering the space. And then outside of that, I'm also heading up some of our DeFi trading initiatives.
Okay, great. So yeah, let's get into it then in terms of the trading strategies. So Evgeny, you mentioned generally market neutral, playing around a lot with these funding rates and things like that. And so that's generally a futures trading strategy, not so much options, right?
No. We love options. Believe me, we love options. Maybe I just forgot to mention it. We love to create certain spreads, and we love to include option spreads within our strategies as a separate legs. So we have multi-leg strategy as well.
So what is that, like calendar spread type trades, things like that?
It's too boring. Calendar spread, I believe. We like diagonals. Okay, like to trade diagonals. We like to play with.
So give me an example of a diagonal. Why you might do a diagonal, for example.
Well, it's pretty simple. For example, within certain market conditions, it's worthwhile to play not only with the strikes, but also with the expiration dates of different legs. I mean, different options. And sometimes, just for example. Yeah, just for example, let me just pause you a sec, because some people in the audience might not know what the hell a diagonal is. So let me just describe that first. So a diagonal spread in options is where you buy an option of a certain strike and maturity, and then you sell an option against it in a different maturity and a different strike. So you're the reason why it's diagonal is because neither of those parameters, strike or maturity, are the same. So go on. So give us an example of why you might trade a diagonal spread. And so basically, that's a simple vertical spread, but as you brilliantly pointed out, it has two different points, like both in strikes and both in expiration dates. So, okay, for example, you might be interested in, let's say, selling something with longer expiration and hedge it with something with shorter expiration. Of course, this hedge will work for a predefined time period, but maybe this will be enough for you.
Okay, so you might be selling the back leg because you think vol's expensive and you want to earn from the vol coming back down or something like that. But you're cognizant that if you're wrong, the market rips against you, you want to have some protection in front of it, basically.
Here we just took a look at the expiration dates. So here we play the expiration dates, and it could be like a calendar spread. But for example, you said you sell something, let's say put. BTC put, for example, at the price with the strike, let's say 80K, just for example. But let's say you hedge it with buying puts with the strike, for example, 85. So not only they have the different expiration, because I sell something expiring, for example, in March, but I hedge it with something expiring, let's say, next week, just for example.
Yeah.
So the long one has the shorter time period, but also it has if the market will go downside at the time the 80K handle will be reached, my hedging spread will have more delta. It will be more than 50% delta, while the sold one will be just around the 50% delta. So these give me some opportunity to play to play with the prices of the premiums and to get additional, let's say, gamma effect hedging while saving money on some premiums. So you can play around this as well.
Sure. Okay, yeah, I actually tend to like doing calendars the other way around myself. I like to buy the back legs and sell the front legs when the curve goes inverted, because I think that front vol has caught a bid because the market's had some big move, but I think the gravity of vol is going to kick back in and the curve's going to collapse. So I like to use calendars that way myself. But, all these different techniques obviously have, they can all work at different times and different environments. So it's good for the listeners, sorry, not the readers, the listeners.
There is no just one unique recipe, you just need to know what to apply and when.
Yeah, and why are you doing it, right? What's your view? Why are you doing it? What are the risks and what are the pros and cons? How about you, Simran? So, what type of strategies are your go-to strategies that you like to do it in crypto options?
In options in particular, I will occasionally trade calendar spreads. I was going to say, given the term structure, the vol term structure typically is in contango or upward sloping on average. I think that the typical carry that most people will put on is just the vol carry trade, right? Long front to back. The challenge becomes the relative sizing of it. Do you do it theta neutral? Do you do it premium neutral? Whatever the case may be. One of the things I particularly enjoy coming from like an oil background, like from my days at Goldman, is really just trading 1x2s or 1x1.5s, right? And what that effectively means is, hey, if you think there is a catalyst on the horizon, either to the upside or to the downside, and you think, hey, if that catalyst realizes and the market feels like it's underpricing it, and I can sell what feels like maybe somewhat expensive vol locally or semi-expensive vol locally, but make sure that I capture my skew scenarios quite well, my tail scenarios quite well, and I can sell 1 unit of where I currently am and get 1.5 or 2 units of something further out at roughly a premium neutral basis, and that seems like a typically good risk reward, right? And what that sets you up for is, so I'll give a prime example, like heading into the election, selling a 1x1.5 or selling a 1x2 in ETH proved to be quite attractive. There was a lot of vol baked in into heading into the election, but it was more of the way I was trading it was more positive spot vol correlation, right? So if vol is expensive, do I want to naked sell it? No. But if I think something is going to materialize and I think markets are going to go up typically and volatility is also going to go up in that direction, I want to have right way gamma, I want to have right way G Vega, I want to have right way Volga, my second and third order Greeks. Then selling one allows me to collect data if the market is just here. And then to the extent that we actually realize, I have all the right way Greeks. So it's kind of one of those not really terminal value plays, more of a path dependent play.
But
you don't get sucked into that. You don't get sucked into the decay hole, basically, right, close to expiring. That's always the risk for those trades. But do you do them delta neutral? Do you do them delta neutral then, those trades?
Typically, no, I'll typically do them premium neutral, which then typically ends up not being delta neutral. But I'm delta hedging it pretty consistently. Sometimes we'll let the delta run. Sometimes we'll hedge more frequently. I mean, the beauty of delta hedging is all it's really trying to do is reduce the variance of your P&L between now and expiry, right? And so having the discretion of, are we in a momentum or a mean reverting environment is kind of where the beauty of delta hedging lies, in my opinion.
Yeah, no, interesting. Yeah, I mean, it's funny because I often like doing the 1x2s the other way around. So just like
you like selling wings.
Yeah, because what I do is I wait for, say the market drops in crypto. Usually the market when the market drops, vol doesn't do much. Often vol goes down, and when the market rallies, vol goes up, right? But you get these occasional occurrences where the market drops and people get scared for the reason it's dropping, and that's when the vol actually goes up on the way down. So then if I want to buy the dip, I like buying the dip via call ratios because I have confidence that in a reversion back higher in the market, the vol's going to come back down. So the devol spot that you normally get in that correlation between spot and vol on the upside flips the other way round. So you have a benefit of that call ratio, and it's like a really cheap way of buying the dip where you're catching a falling knife. But if the market just goes down another 10%, you don't care because you didn't spend any premium or very little premium. But if you get the bounce, there's a very high probability the vol gets crushed and your call ratio expands in value, basically. So yeah.
I think that's a very smart move. Yeah.
I was going to say, it depends on what spot vol regime you think you're in, right? Like, for example, in 2024, we've seen a regime dominated by positive spot vol correlation, in which case, then it's the other way around where it's like, hey, price up, vol up, price down, vol down. But to your point, there are these instances like, for example, think of your FTX collapses, right? Think of all 2022 where it was price down, vol up, and then you begin to behave like equities, for lack of a better example.
Yeah.
And the beauty of crypto, one of the reasons I love it is actually it reminds me of metals, right? Instead of just being dominated by put skew all the time, you actually do have a very rich call skew. Now, a lot of that is dampened by a lot of people going out and selling calls to harvest yield. And that seems to be the predominant flow in a lot of crypto when it comes to how people use options, at least how retail uses options. But I would say you still see these bursts of positive spot vol correlation, which tend to dominate over a few months to a few years. So it really depends on what regime you're in. But yeah, that totally makes sense.
Yeah, 100%. I mean, that's what it's all about. But speak a bit more about the flow. So what do you think is if you had to kind of summarize what the market structure is in crypto options, based on the kind of typical flows that are out there, well, how would you summarize that right now?
Well, it's typically between contango and backwardation, as usually, by contango and backwardation in options, we mean that the options with longer strikes have they carry usually higher implied volatility, and this is a
classical contango situation. While, for example, if the short-term options start to accumulate higher implied volatility, this is a backwardation situation. And usually the market is somewhere in between. But the issue is that markets, especially crypto markets, inherently very often over-optimistic or too pessimistic. So there is no healthy balance. And options actually is the great tool to capitalize on this.
Okay, so you think it overshoots in both directions, basically?
Of course.
Yeah. Okay. But like market structure wise, like Simran, you might be able to speak to this being a market maker, right? Like what are the kind of ongoing systematic flows that are kind of essentially ending up on market makers' books, right? Is it okay? Because I know in equities, for example, there's just so much gamma selling, right? So generally, dealer books are going to be flooded with local gamma, and they're going to be probably short a bit of medium-term Vega. They're going to be long loads of long-term Vega, and they're going to be short skew pretty much all the time. So they're going to be short puts and long calls, right? That's how I would categorize equity market structure in, say, S&P, for example. Is there enough of a systematic pattern in the flows in crypto that you could summarize?
The short answer is, unfortunately, it's also regime dependent, right? Like what we saw in 2023 during the summer, and I think you touched on this earlier as well, was, at least in my time in crypto, one of the largest vol selling programs where someone was literally just coming in during the summer, selling a bunch of ETH covered calls that was compressing implied vols and realized vols to levels that like we hadn't seen in an incredibly long time, right? And everyone was scrambling to be like, who is trading this? How are they trading it? On screen directly. They're paying a lot of slippage. What is going on? What are we missing? And then that person had to unwind a bunch of positions and got a little bit hurt on the rally, we'll just say. But I haven't seen anything quite like that per se in, since then. What we did see is heading into the election, there was a bunch of just upside buying, right? And like you'll see occasionally large funds, VC back with like some liquid fund strategies come in and say, hey, I want to buy something directional, whether it's I want to buy some downside puts, which were prevalent, once we saw this correction early Feb, or even during the yen carry unwind where people were coming out of the woodworks to be like, hey, I need to buy some downside protection, or people saying, hey, I want to put on an election play, let me go buy some bridge call skew, whether it's 85, 95, 100K, which now doesn't seem like that crazy of an idea in hindsight. But you'll have people occasionally come out driven by certain macro impetuses or some other idiosyncratic noise. But I don't think there's really a general flow outside of people simply wanting to sell calls, right? And like when you think about whether it's altcoin treasury projects, whether it's people who are just only trading the liquid majors, call selling tends to be, and just vol selling in general, just tends to be the predominant flow, because who wants to pay a premium when you can simply collect premium, right? And I think that tends to be a psychological thing that just permeates through all of crypto retail, right? It's more of just where is my yield coming from? And if I can just generate an incremental 10%, 12%, 20% annualized by simply selling wings, that tends to be the dominant flow, which then tends to leave market makers typically long skew for the most part, except for when you have these occasional buying spurts that we saw heading into the election, I would say. So the predominant flow is mostly just vol selling into the market.
And it's normally call selling, not put selling, right?
Normally call selling, right? Because part of the reason is, if you think about what a lot of crypto projects in general are rich in, right? They're rich in native token supply. And typically when they're selling calls, they're doing it in covered call format. So they're posting tokens as collateral, which is used as a yield enhancement strategy. If they were selling puts, it would be wrong way risk for market makers to use the tokens as collateral. And typically not everyone wants to collateralize in stablecoin or something that would be right way risk. So calls tend to be the preferred form, but it's also a nice way of risk managing, right? If you're sitting on a large pile of tokens and you're saying, hey, if this thing appreciates, I want to de-risk a little bit, calls just form as a natural element to do that, right? So even if they're not looking at it as a yield product, they're looking at it as a hedge, it still makes sense.
Yeah, and the good thing about that is like both sides of that trade can actually do all right, because the call seller owns the underlying and is happy to take the yield, and if he gets taken out of some of his position, he doesn't mind. But the guy who buys that gamma, who buys those calls, can delta hedge them, and if there's enough realized vol to scalp around, both sides of the trade can win, which is quite a nice outcome, right?
Agree.
Well, what are your thoughts on altcoin options? Do you see altcoin options as a big kind of part of the space, or are they just not developed enough? They're not liquid enough, not enough flows going on, not enough maturities to trade. That's kind of been my experience. I feel like I'm still waiting for altcoins to really join the party, but right now ETH and Bitcoin's where it's at for me.
I believe we don't have enough. We don't. Sorry for interrupting.
Go for it.
I believe we don't have sufficient liquidity currently, and actually, I don't see that the situation will get better maybe within the next 12-24 months. Anyway, a lot of traders are anticipating the alt season coin just to start, and they just discussing what the catalysts are behind, what will trigger this event on this BTC halving curve, because it's on this curve, it's still somewhere ahead. And the main thing that I just observed is that people discuss seasonality, they discuss politics, macroeconomics, how the, let's say, market sentiment and equities can affect the crypto, but of course in much more amplified manner, and blah blah blah. And the main thing we can just see that they all assume that we are still in a bull market. I'm not going to argue whether it's a right or wrong statement. Time will show. However, they all even do not want to think, what if it's over? And how can we talk about the derivative development if everybody thinks that we are still in the bull market?
Interesting.
Hopium runs high in crypto, I think is the way I would summarize that. I would ask a more naive question, right? Which is, what do you think needs to happen to organically lead to the development of an altcoin options market? And the reason why I ask that very, in my opinion, simplistic question is like, the primary use case for derivatives, and includes perps as well, right? In crypto is speculation, right? Like most people, like in traditional markets, you actually have hedgers in the world, right? The country of Mexico has the largest hedge program in the world. When I was sitting on the oil desk, like we were quoting them pricing. It was one of the coolest experiences, but also like one of the most stressful experiences, right? Because it's like you're quoting the country of Mexico. But in crypto, hedging is like one of those things that you only do if you think that the market might go down, and who thinks the market might go down. So realistically, most people are using derivatives for speculation. We are trying to educate a lot of clients and protocols of like, hey, we think about long-term growth, we think about long-term strategy, you want to use derivatives to hedge as well. But when I look across all of retail, when I look across the predominant flows in crypto, it's purely speculation. If that speculative appetite can be met simply by getting leverage via perpetuals and trading linear derivatives, then really, who wants to pay 20, 30 vols of bid offer to trade an option 10% of the money on altcoin number 673 on CoinGecko? That's really the question, right?
No, I think you've hit the nail on the head. I totally agree. I think the actual underlying feels too much like an option itself. But why do I need an option on an option, right?
Yep. The vol is high. The vol of vol is high, and so it's like if the retail appetite can be met, if the speculative appetite can be met by simply trading perps, why wouldn't you? Or just owning the spot. The other part of it is you could argue that hey, counterparties or players like venture capitalists who have these locked tokens might want to use this to hedge, but then it's like it becomes a capital efficiency thing. Oftentimes they just choose to hedge via perpetuals or trade OTC forwards, and there are other mechanisms for them to hedge. In which case, like, I would almost argue you need a liquid forward market before you have the emergence of a liquid altcoin options market, right? And so to talk about a liquid altcoin options market, I think is like putting the cart well before the horse in that regard.
Yeah, I hear you. Yeah. All right, but you mentioned Skew earlier, and I'd like to talk a little bit more about how you trade Skew, because there's a couple of ways to think about Skew, right? You can think about it just like a number that trades in a range, and when it gets to the top of the range, you want to sell it. When it gets to the bottom of the range, you want to buy it, right? That's kind of like trading the implied Skew. And what I've noticed about crypto is like the long-term Skew just always stays for calls, and then short-term Skew just kind of chases the market up and down. Basically, whenever the market's rallying, it goes into call Skew. Whenever the market's selling off, it goes into put Skew. How do you guys think about Skew, and how do you think about trading it?
Well, I think the main thing we need to predefine is the time horizon, first of all. So the time horizon of your strategy. And talking about the options, usually reflecting on our past, what we did recently, our time horizon. Okay, most of the money, of course, you can make trading with weekly options, but they're the most volatile and more risky. So you should, but at the same time, if you know how to hedge them properly, you still can allow yourself certain exposure. So I think that's quite individual. It's very, very individually. But first of all, you need to define the investment horizon, the delta of your hedge. So how much of exposure you're going to take, and then you just need to understand if it's worthwhile within a particular market situation.
What would be your typical holding period for a skew position then?
I would say no more than 2 weeks.
2 weeks, okay. And you'd sell one.
That's maximum.
And you sell 1 month skew, or would you go a bit longer dated than that?
It can be this way, but it can be much shorter iterations. It can be just like 3 days against maybe 14 days.
Okay. How about you, Simran? What do you think about skew?
Mm-hmm.
So I usually trade it either as an expression of spot vol correlation, or I will
That's like the realized element to skew, right?
Yeah, effectively. And like what you could theoretically do is say, hey, I have an empirical distribution of like realized returns. I fit whatever the implied curve on it is. If the density implied by the market seems rich or cheap relative to where I expect it to be, then you can trade around it. And yeah, in terms of dynamics, I think you hit the nail on the head. Part of it kind of reminds me of oil as well, where no matter what was going on typically in the markets, the really, really, really wingy calls always had some sort of premium baked into them because you don't know what's going to go on. It's the Middle East, right? Like anything can happen. So it's one of those like really, really wingy insurance policies to the upside. And I think long-term skew in crypto behave the same way, where it's like short-term dynamics are dominated by like whatever the newest headline is and whatever the very short-term sentiment is. But by the time you get to like 3 months onwards out, you tend to have this rich call skew. And then the other part of it is like no one, at least my experience, is like really, really that active beyond the 6 month out horizon, right? Like when you think about what the liquidity distribution of the curve is, no one is really further out like than 3 to 6 months. And I'm curious to see how that will evolve as you see more institutional players perhaps entering the space who, again, in a bid to offer yield to individuals, might come and start selling that back end vol, back end skew, which I'm sure will have interesting dynamics on whether the term structure remains in contango on average or intrusive to backwardation.
Yeah, one thing me and Greg Magadini, I don't know, you may know him from Amber Data. One thing we discussed was like how because the funding rate has a correlation to what spot's doing, it basically makes the forwards more volatile in the back end, right? So that's like a property that you don't have in TradFi, right? Where, you know, those forwards are basically going more and more bid when you're in a bull market because the funding rate blows out to 20% or whatever. And then in a bear market, it comes crashing down and it makes the forwards drop by more. So that in itself means that if you're delta hedging using those forwards, you're getting more volatility out of the long end than you otherwise would if you're using perps to do your delta hedging, right?
Yeah, that's
the vol.
Yeah. Okay.
Yeah.
Speaking of delta hedging, so obviously crypto never sleeps, right? 24/7 market, which, you know, is unlike anything in TradFi. So does that impact how you guys manage your gamma in terms of the hedging frequency of when you want to go delta neutral? Because, you know, back in the day when I used to trade equity derivatives, yeah, we'd wait till the end of the day to do the bulk of our delta hedging because that's the end of the day, right? But there is no end of day in crypto, right? So what do you do? How do you approach that? Is there a different way of thinking about the hedging within a kind of more continuous market?
So there's two components, right? One is how are you computing a realized vol in a market that doesn't close because you have no close on close. The other is how do you inform your hedging frequency? What you could do is like one example is if you just take hourly prices, compute realized vols, and then you can see, hey, is there a seasonality, intraday seasonality to your realized vol? And you'll often find that like, hey, certain sessions are more active than others, right? The US session tends to be more active. The APAC session tends to be more active. The EMEA session, like part of it will be more active, but that's really just the tail end of typically like Asian retail order flow coming through. But you'll often find that like, if you average out throughout the day, you get something close enough to like close on close, where close on close, you can really just say it's midnight UTC just for convenience sake. And if I just do midnight UTC snapshots, you'll converge to something very similar in that regards. So that's one question is like, how do you think about vol in a market that doesn't have a close? The other part of it is how do you use this to inform your delta hedging? And so I sit on a different side of the business than, let's say, our typical market making side of the business. And what they effectively look at is saying, hey, what is the frequency with which you should hedge our delta? And that can be driven by intraday volatility, that can be driven by liquidity constraints, that can be driven by, hey, what is our broader view and are we in a momentum environment or a mean reversion environment, right? If you're leaning long gamma, you probably want to ride the Momo longer rather than necessarily taking profit sooner. If you're leaning short gamma, then you probably want to make sure that you're risk managing more aggressively in a momentum environment versus if you think you're in a mean reverting environment, you think it's going to collapse anyways, so there's no really reason to crystallize the negative gamma P&L in that case. So those are really two questions, right? How do you take into account intraday volatility effects, and then two, how do you use that to inform the frequency of your delta hedging?
Cool. All right. Well, before we wrap up, I mean, it'd be remiss for me to not ask you guys what you thought of the market right now. Right? You're prop traders. You've obviously got books. You got positions. So I'm gonna put you on the spot and say, what's your favorite trade right now, basically? So who wants to go first?
I volunteer, Evgeny.
Oh, okay. Favorite trade right now. Go on. What would you do? None of this is investment advice, by the way, everyone. Yeah.
Since we expect this spike of volatilities, let me just describe our strategic view. I think a lot of traders now overlook that within the next 12 months, there will be a lot of unlocks in totaling in over between 35 and 40 billion USD. So basically it means more than 9 billion per quarter.
Okay, so and that's across the altcoin space, right?
And historically, when these great unlocks happen, actually it just wipes out all the liquidity. Okay, because a lot of investors who are already deep in the market, they're just sitting and waiting to grab they're just waiting to have these yields. And so I think this will add some turbulence. And I don't think that we will. So the spikes and volatility can appear at any moment. And we believe our investment thesis that within the next 12 months the volatility will spike. So
this is just general crypto volatility, right?
General crypto volatility, of course. General crypto volatility, general crypto volatility.
Yeah.
So having this predisposition, we need to capitalize on the potentially increase in volatility on these breakouts, and this will define our strategical sets.
Okay, so it sounds like you want to be long vol, basically. But
basically, we will combine. We will try to capitalize time with market neutral approaches because we never know when this event will occur. Actually,
yeah.
While waiting, still making some.
Then does that mean you own 6-month vol and you fund it with short dated vol and you kind of be long Vega that way, or is it a case of you just want to be long wings or something because you say,
for example, we can earn a stable funding rates arbitrage, let's say on crypto, or let's say we can make certain market making in DeFi protocols. So we can combine these approaches while trying to capture volatility with options.
Sure. So you do yield earning strategies that are then funding your long vol position, essentially.
Of course, options are great when you need to capture certain situation. For us, it's more opportunistic approach.
Yeah. Okay. Fair enough. How about you, Simran? Favorite trade right now?
I've got a few that come top of chart.
Okay, good. Juicy. Got a few for us.
I mean, nothing really. I think like right now, short dated vol is pretty expensive just because like we're still recovering from the fear of what we saw early Feb. This whole tariff noise is kind of overblown. We'll see what actually paralyzes. So when talking about two week to 1 month vol, I'd probably lean slightly short. You can do that in straddle form, strangle form, in really whatever form you prefer. More long term, I definitely agree with Evgeny in the sense that the whole VC funded high FDV altcoin token world is certainly ripe for massive unlocks coming. So that's going to put a lot of downward pressure. That said, I think crypto has shown itself to be high on hopium and have a sense of resiliency where despite all these unlocks, despite, oftentimes retail getting dumped on, for lack of a better word, it has shown its appetite to be there. And thinking more broadly, thinking about the regulatory and legal landscape, given the fact that we've had a record number of pro-crypto legislators in the US come into office, right? Now it's going to be a time to see whether they can put their money where their mouth is and actually pass legislation that makes a lot of sense. If that happens, not even thinking about this whole Bitcoin strategic reserve or anything, right? But even if we get meaningful reform, I think you'll begin to see more and more players enter into the space. And I think it'll generally be a bullish catalyst for Bitcoin and the crypto space as a whole. I wouldn't mind owning some really, cheap, wingy, tight call spreads to replicate a binary, whether that's 125, 130 call spread, something like one year out. It's not that expensive. You can get it relatively cheap. I think last time I was looking at it, it was maybe 6%. I have to see where it's at now. But yeah, I would say owning some wingy, long dated call side, at least until the end of the year, is probably something I would not be opposed to, right? And
So on Bitcoin, yeah?
yeah, on Bitcoin.
Yeah. What do you think about this ETH underperformance? Is this ever gonna turn around? Because it has just been a dog for so long relative to Bitcoin. I mean, and the unlocks you're talking about, do they particularly put pressure on ETH rather than anything else because of the whole DeFi world is more, it's not like necessarily unlocking a supply of Bitcoin, is it? So is that one of the reasons why ETH stays heavy?
I think one of the reasons why ETH is underperformed is just the value proposition has just gone all the way to layer 2s, right? Layer 2s is where all the activity on Ethereum really is, and they'll just settle on ETH. So the question is what is really the value proposition outside of earning a 3 to 4% staking yield on ETH, which I can get in treasuries or much higher in DeFi, or just by putting on the basis trade and getting 11% annualized by going long spot short put, right? So there's many other ways that I can get the yield, and if the value proposition in terms of fee accrual is just not there, what's really going to drive it? Versus when we think about this altcoin mania that has happened over the past few months, Solana has been the big name that has continuously resurfaced to the top, right? For example, you've got massive MEV there, you've got massive tokens that are being launched in terms of altcoins there. I would say a lot of the bearish sentiments around Solana in general have not necessarily died down, but they've been muted. I mean, you have unlocks coming there as well. There's the whole FTX estate that needs to be considered. But beyond that, I think Solana is probably going to continue to outperform ETH for a very long time. The one thing that I would voice is ETH still has first mover advantage. And when you think about ETF inflows, that could be the one thing that really changes the narrative there of as there is regulatory clarity and you have larger institutions say, hey, I want to diversify exposure, I want to park some capital into Bitcoin, then other thing they can park capital into is ETH. And so you see the launch of potentially an ETH ETF that then drives that. But because ETH still has first mover advantage and is this legacy blue blood asset, right? It makes it hard to recover from that. But
yeah, no, it's just been an interesting one because I mean, I've got the three. I've got ETH, Bitcoin, and Solana, but I've just been surprised at just how poorly ETH has performed. Right, it's pretty.
my friends now call ETH an altcoin. And they're just you can't call it a blue chip anymore. It's now official altcoin. I'm
yeah. All right, guys. Well, it's been a great discussion. Lots of juicy stuff in there for the people who are trading and playing around with options. Hopefully it wasn't over people's heads and they understood what we were talking about. But otherwise. Hopefully get to chat to you guys again sometime, but thanks for coming on the show.
Thank you for having us.
Very much. Take care, guys. All right. So what do you reckon?
Yeah, good. Yeah, great conversation that.
Yeah.
Covered
Always
a
good.
lot. Yeah.
Always good to chat to some vol guys, close to my heart, obviously.
Yeah, indeed. And it's really good, broad discussion on things. Trying to think about what my takeaway from it is, and I guess it kind of speaks to what we've discussed here with short term, it might be a little bit rangy. So wanting to keep sort of short vol in the front end, short gamma, and then position for this potential blowout longer.
Yeah, so essentially a calendar trade, right? Where I think it's a tough one on Bitcoin right now because the curve's quite steep. It's gone into contango. It's quite steep. The front's on the 40 handle. But ETH is obviously, because that front end is holding a premium because ETH's moved so much relative to Bitcoin. I think the ETH curve's flat at around 68 vol right now. So like there is a case to say that if we do kind of consolidate a bit, ETH front end has maybe got 10 vols of downside, but overall you want to own some Vega because the space is going to stay volatile. You've got all these unlocks coming in all the alt space that they mentioned. So maybe a calendar on ETH is kind of the trade to walk away with.
That's interesting. I think the other thing as well is like talk about all the token unlocks and stuff like that. We're so used to this idea that like in the explosive move of the bull market that Bitcoin dominance falls. I've been talking about that. And almost we're looking for that as the trigger to like for this the banana zone and what have you and everything to pump. Maybe this is where this cycle is different.
Yeah,
you know,
maybe
we just see Bitcoin, particularly given the like impact of the institutional flows. We just see Bitcoin outperforming. Like everything can go up still, but maybe Bitcoin just keeps going up.
And
do
you know much about these layer 2s on Bitcoin as well? Isn't that a big growth area right now as well?
Yeah, no, with the ordinals and all that sort of stuff.
Yeah, because that changes the dynamic a little bit as well, right?
Yeah, and like I get asked a lot of questions generally on altcoins and why are we not performing, and maybe there is like a dilution of capital there in terms there are so many competitors. Obviously you got like the whole meme coin stuff going on as well, and I do actually think in the last cycle, it was like all the altcoin stuff and the layer ones and some of the new layer 2s and everything that was coming on, and people were aping into all that stuff, and maybe now the retail attention's on the meme coin stuff. So whilst the grown-up money, if you like, is just all coming into Bitcoin. So each cycle's different. Still think ETH. I mean, we've been wrong on ETH. Let's face it.
Everyone's been wrong on ETH.
Yeah, and we keep expecting that to blow out. But yeah, maybe this March upgrade comes along.
I think it will be a momentary pop though, even if it does. But I think it's funny because I run my crypto vaults, right?
Yeah, yes.
My systematic strategies. So one of them is like an iron condor selling strategy to earn premium. And obviously we've had some pretty wild moves to contend with, but the thing survived. Because it's iron condor, it's not naked risk. The thing survived quite well. But basically when we had that big ETH washout, I was closing out all my way out of the money short call spreads, but I wasn't replenishing them with new ones because like this thing's so beaten up. I want to wait for it to bounce before selling them. Yeah. So for me, it's like if ETH pops back above 3,000, then I'll happily come and slap it. But right here, I don't want to sell a load of call spreads with much lower strikes when we've dropped so much and then just get ripped back through it. Right. So I think there's probably going to be a lot of people who are waiting for that bounce in ETH back above 3,000 before reselling it. But then they will come and resell it. So it'll be quite short-lived, I think.
So your vaults are performing then?
They're doing all right. The crypto wheel's the best performer right now, which is generating about 8%. It's managed to generate about 8% in a month, right?
Yeah.
Now, in dollar value, it's dropped a lot because I'm doing it on ETH and ETH's lost like 30% or something, right? But in terms of actual crypto yield that it's generated, I can't complain. Yeah.
Nice, mate. Nice.
All right, cool. So we'll call it a day for today's episode. Hopefully you enjoyed that and that in-depth discussion around crypto vol. Remember to like and subscribe to the channel.
Subscribe.
So you get notifications on these videos, and we'll catch you all back again next week.